No worries.
All right, guys, welcome to the show. This is the top 10 tips to crack 2022 and how to build wealth in 2022 as well. So on tonight, we've got myself and then we've got James Watson. James is a prolific investor as well. I've been a property investor for, God, coming on 30 years now, James. Flipping heck. That's mental. I remember my journey. I remember my journey because I remember early 20s, I was homeless and unemployed. And it was through no fault of my own. I mean, we could go into that, but we'll be here forever talking about that story, and I will talk about it one day. And I always felt to myself that I never wanted to be owned and controlled by someone else. I always felt that because of that, and because that was taken out of my hands, that I felt that I needed to do something outside of what I normally do. But see, at that point in time, I never had any idea what to do. I didn't know what that was or where it's going to come about. I always felt that there was something, because look at all these, I mean, I used to look at all these wealthy people and think, how on earth do they manage to do this? How on earth do they manage to create so much wealth? What do they do? I was cynical a wee bit at that time. I used to look at the books and they used to say, how to be a millionaire, and and I used to went, how to be a millionaire, write a book and sell it to everybody. And then you'll be a millionaire. but that still exists today, doesn't it? People do that, don't they?
Absolutely. Yeah.
They do that with property. I mean, a lot of people actually teach property investment strategies, but the reality is they're virtually just one step ahead of you, if not no step ahead at all. And they come across as the wealthy guru when in actual fact they've not got any track record at all. We've seen that loads of times, haven't we?
Absolutely.
Yeah, so that was I didn't know the vehicle at the time, and then I tell you what I did was I went back to college, because at that time I thought, right, okay, I need to go to college. Then I found my calling in accountancy, believe it or no, something that I failed miserably at school, which I was quite surprised about, and yet I found my calling in accountancy and I genuinely, and you'll laugh at this, I genuinely thought at that time I was going to be a millionaire being an accountant. No idea how that was and why that transpired, but I genuinely thought at that time that was going to be the case, that I would actually be that wealthy being an accountant. And then I trained for 3 or 4 years, and then I'd done another 3 or 4 years professionals, and then I realised at the end of that, it's like, wait a minute, I'm just working for someone else. It's like I am exactly where I am before, and if not in the same sort of position, but just a wee bit wealthier, if that makes sense.
Absolutely. I'm similar background. I'm an IT software tester, and I did have my own business working for a day rate, but with various tax changes and things, that's no longer viable.
So that then led me to what I saw at the time was the vehicle was property. I began to realise that, wait a minute, no one else is doing this. I had no idea at the time about what to do, how to do it, because things like property training programs never existed. Buy-to-let mortgages never existed until 5 years after I'd started. So I had to reinvent a wheel. I had to invent a wheel, actually, not even reinvent a wheel. I had to invent a wheel that didn't exist. So I built it up from that and got involved in property. Tried out for the first time. It's a big, long story, and I will tell it one day. But it was trial and error for me and working it all out. And I didn't know what to do at that time, but I just became. I almost became. It was almost like I went back to university again. It's like you spend your whole life at university paying for the privilege to learn, and you're taking out loans all the time to learn for 4 or 5 years to get yourself a job, or maybe not even get yourself a job at the end of it, and then you're completely in debt. But for me, it was more or less like, wait a minute, I'm actually doing it at the same time and learning as I go, and I'm making money as I go as well. I wasn't paying for this. I was actually making money while I was learning on the job. And it made absolute sense. And the great thing about what I was doing was I was able to do it outside of my normal day-to-day work. So I was earning my income at my work as well. I mean, is that a similar situation for you?
Yeah, I'm a similar situation. So obviously I haven't been in property for 30 plus years or whatever, but yeah, I started my journey just a number of years ago, and similar situation, working for someone else now. So got a reasonable salary, in fact, well above the medium, to be fair. But ultimately, I started investing in property for much the same reasons as you've suggested.
Yeah.
Rather than spending money on liabilities, the big fancy car or a house that's out with my means or whatever, then buy the assets.
And understanding, you get that now. But to most people watching just now, they'll probably not have a clue what you're talking about. Because at that time, I never knew that either. So when you say all these words, it's like, what does that mean? And I had no idea either. And it was only so happens that I managed to get in touch with the right people and read the right books. They weren't in property, but they were in other fields that were really successful in that era. And at that time, I was able to learn from them how to build a business successfully and build a system successfully in terms of what I was doing, and still sustain my current day-to-day job. I'm never a fan for most people of saying, give up your job and go into property full-time. I've never been a fan of that. What's your thoughts?
So I think you're probably right. In the early days, you don't want to give up the job because obviously it's still paying all your bills and things. The mortgage, the electricity, various taxes, insurance, that sort of thing. Property initially becomes a sort of kind of like a sort of side hustle initially.
Yeah.
But once you start to scale it, then you can start thinking about, well, what does life hold for me beyond 8, 10, 15, whatever houses or properties anyway. But yeah, you have to be careful that you don't throw in the towel too quick.
It is that initial feeling, isn't it? It is that initial feeling of fear in the beginning when you didn't know what to do. I mean, how did you feel about that? I mean, did you feel
Absolutely. Yeah. So, I mean, there's a lot of resources now compared to when you started, Jim, online and stuff like that. So there's things that you can learn yourself.
Yeah.
Without spending in excess of £8,000, £9,000, £10,000 on a course that
it's crazy. Yeah?
It won't tell you more.
I tell you what though, it is worth spending that money on the right people. But it is essentially, and we'll do another show on that about the right people and who you should be speaking to and how to know who the right people are.
Yeah.
But for now, I kind of thought we would cover over the background. I mean, I was lucky enough to retire financially free 17 years ago now. Now it's 38. I'd always set a goal for myself before 40 to actually retire. And I managed to do it at 38 because I got up to 30 properties. So that was able to sustain me and actually build from there. I just got to a point where it was like I was running that at the same time as running my full-time job as a financial controller. Yeah. And one of them had to give. And I felt that I was going to make more money in the future in property than I was as a financial controller. So literally, it was a decision I had to make. It took me a number of years to get over that in my mind because I didn't really believe the fact that I was earning the same amount of money I was as a financial controller, but I was earning it in 1.5 days a week. I just, blew my mind.
And the thing now, compared to when you first started, obviously, that it's now a well-beaten path. You're going into buy, refurb, refinance situations or flipping or whatever. So people have already beaten that path. So you can learn off other people as well, and it's absolutely free. There's certain things I'll know that somebody else doesn't know, and we'll just share information.
That's really what it's down to, and this is why I got you on to talk about the top 10 tips to crack 2022 and build wealth, because I think it's important to start that journey for everybody and let them see. So this is going to be a series of events over the next year. James and I are going to do and talking about wealth creation and also property investment and other vehicles as well. I mean, we'll probably just discuss crypto at one point in time, but I kind of think that's going to be a short discussion.
That's all I do.
Yeah.
I think we've lost your connection, Jim.
Business, so it's actually teaching other people how to do it. So it's no surprise when I tell people I've become a multimillionaire out of this, and it will continue to build as a result of that. So it is actually understanding the people that have a track record and then learning from them what they do and how they do it in order to succeed for you later on. So we're going to talk about 10 top tips to crack 2022 and build wealth. The first one I've got here is never spend it until you get it.
Absolutely.
Well, and what do we mean by this? If it's not in your bank, don't spend it. Don't start overextending yourself. Don't start running away and spending things left, right, and centre. And what we mean is by spend is we're talking about actual what we call liabilities. It's a car is a liability, isn't it, James? What else is a liability?
Credit cards is a big one. It's a negative debt.
Yeah.
I mean, we'll obviously get onto things like what's a positive and what's a negative debt, but things like credit cards and things, you're paying 20% APR typically. And if you just stick
we could be forever about that. I mean, the first thing you do if you're going to pay down debt is go for the big thing with the highest interest.
Absolutely, and don't ever pay the minimum.
Yeah, and credit cards are more than likely the thing that you'll go for all the time, but never spend it until you get it. It's important that you don't spend things that you don't, and I would say is you don't need. Now, what I mean by that, it means by there's a difference here. There's a want and a need. Okay, and I should have corrected myself there. It's not don't need. It's like there's a want and a need. If you want it, it's different from if you need it. So classic example is you recently, and I really take my hat off to you, James, and the fact that we had a discussion about cars, and I was like, whoa, wait a minute, I would never buy a car and shell out all that money for something that's a depreciating asset when I could take that same amount of money, put it into a house, and earn the same amount of money it would cost to lease the car. And I would have the house as well. And the house would double in value over the next 10 to 15 years. So I've now taken an income-producing asset in order to buy the car and lease it. And we'll talk about leases as well later on and how that fits in. But that's the reality, isn't it? I mean, and first thing you did was like, looked at your car and thought, I'm keeping it.
Well, exactly. Well, the thing is, there's nothing actually wrong with the car. It's 10 years old now. It's a diesel, obviously. We know we're going towards electric, but the mileage is good in it. The emissions are quite relatively low. I think I still pay 20 quid road tax a year. So
run them to the ground. I mean, essentially run them to the ground till it comes a point where, and we'll talk about that as well. A typical example of cars is if it gets to a point where it actually costs you more to maintain it than it does to actually lease it. You've been as well just leasing a car then, if that's the case.
The thing with leases is you get maintenance packages as well, so it's ideal.
And we'll talk about leasing because how it's important about capital and tying it up, and if you don't lease and end up buying for cash. Buying for cash is not a big thing if you're buying a liability, and we'll tell you the reason why. So the first one is don't spend it until you get it, okay? So the classic example, the next one we would talk about, and this is probably the one, and this takes huge discipline, doesn't it? The 40% rule. Okay, so what do we mean about the 40% rule? Well, the 40% rule is basically 40% of your income is going to be paid on taxes, isn't it? So it's going to be national insurance contributions. It's going to be tax itself. Now, it could be less. It could be a wee bit more for some higher earners. But the reality is 40% of your income is going to go. 40% of your income should be invested, or as much as you can get away with because you want to invest it. And I'll show you in a minute why you want to invest it. And 20% of your income you live on. Now, that's not going to be easy for some people because they've got themselves to a stage, really, that they've actually built so much debt that they've got to service that debt. So it's all about having to be a bit more leaner in order to get that down to a tolerable level where you can actually do that. Now, for the younger audience out there, it's brilliant because they're off to a good start because they've probably not acquired all this debt now, and therefore they're able to do this and actually invest. Now, what do I mean by that? So a classic example out of this. Let's talk about the 40% rule later on because it coincides with the 47 rule, and I'll talk about that at number 6. So we'll talk about that. So the reality is you live on. So if you're earning, for example, say if you're earning what's the average wage just now? What's the average salary in Fife?
I don't think average salary is about 26,000 a year or something.
Aye, it's actually. I had a quick look and I saw 25,000. So if you did 25,000, 40% of that is basically, and I'll quickly share that screen actually because I show it in here, and I will come back to it as well in this scenario. So 40%. Here's the 47 rule. See that? Okay.
Yeah.
So there's your 40% rule there. There's you've got 25,000 as the average salary. The tax is 10,000. The investment's 10,000, and you spend 5,000, and that's the reality. That's what you've got to spend. That's it in a nutshell. And it doesn't seem like much, but if you discipline yourself to invest that 10,000, I'll show you in a minute how that'll transpire. In terms of that, actually, let's talk about that now, and let's see that investment here. Classic example. Let's jump onto this other screen. There's a wee bit of logistics here. And where are we? The compounding interest calculator. You see that okay?
Yep.
Compound interest calculator, you've got initial balance of 0. You've got 0 here, interest rate. You've got 40 years. You've got yearly compounded as 1 year. You've got the amount you put away every year is 10,000, and it's yearly. So if we calculate that basically over 40 years, your £10,000 is 400,000. That makes sense, doesn't it?
Yep, absolutely.
So 400,000 is going away every single year on your savings. Now, classic example of this. If you say that was going to increase it, maybe a 2%? Do you think you'll manage to get 2% every year?
I think average pay rise is around about somewhere between 2 and 3%.
Yeah. So, but if you invested money now, would you manage to get 2% every year?
I don't see why not. Pensions are generally about 5 to 6% at the moment.
Well, we could talk about that. See,
standard savings.
There's a classic. There's the 400,000 that you've put away over 40 years, and it's increased by 2% every year, and it's compounded up to 600,000 at the end of it. So you've actually earned 200,000 interest on it. Now, you were talking about the investment return, and when you look at this as well, and you say, I tell you what, imagine if it went up to 4% per year, and where that would end up. So 4% per year, same money. So 4% per year has now gone up from 400,000 to 950,000, and there's a 550,000 increase in interest that you would earn. Now, obviously, inflationary pressure has got to be brought into about as well. So, but can you see how that compounds up? Normally, you would just think it's 400,000, it'd be 4% every year. But what's happening is 4% every year of 10%. So 4%, 10%, 10,000 times 0.04 is £400 every year. So £400 every year over 4 years, over 40 years is really only what, £16,000?
60,000, yeah.
So how on earth did we manage to get to 950,000 if we've only got 400,000 and we've got 16,000 there? It's compounding in terms of wealth. So that's one of the things that we need to talk about later on. But we'll jump off that then out. And that is the 40-20 rule. It's a 40% rule that we need to talk about. So 40% rule. The next one is, if you can't write it off, don't buy it. What do we mean by that? Business assets.
Mm-hmm.
Stuff that you can use. A classic example of that for me is company car. I don't physically own a car. And I have no intention of owning a car because I can't really get any deduction. It's just a depreciating asset straight away. And I could utilize that money a lot better on everything else. That's exactly how the discipline that you have to do in order to do that. I mean, a lot of people out there, they want big cars, don't they?
Yep. Big cars or big performing cars or whatever. And
it's great. We don't decry anybody for that. It's just that I've learned over the years that as much as I want it, here's a classic example. I bought a Mini Cooper S, right? When the first came out, it was off the production line. It was tailor-made to someone. It had the cinema box office in it, so it had the DVD players and the headrests. It had the tinted windows. It had the chili pack. It was souped up, and it basically at that time it cost me. It was a £20,000 car. I was lucky enough to get it as a cancelled order from someone. They had paid a £5,000 deposit, so I was able to buy it for 17,000, brand new off the forecourt. Now at that time it was a lot of money, and it probably still is today. But the reality is, what I found was it just sat in the garage for the next 3 years, and I did 3,000 miles on it. It was literally a toy, and then I could have kicked myself because I felt that I had £17,000 and it had completely depreciated. I'd probably lost. I think when I traded it in, I got about 12 for it, so I lost £5,000 straight away. plus the fact I'd kept it for all these years, and I could have made more money in that with the money and the 17,000 because I paid cash at that time. Paid cash for it, and I went in and I could have taken that 17,000 and bought a house, which actually could have leased that car.
Yeah, and back to your point about that, obviously we've been living under COVID conditions for the last couple of years anyway, so you know, my annual mileage this year's been about 900 miles, I think, all in.
Aye. And then they tell you to get it serviced again. It's like, wait a minute.
Yeah. And I always have to...
I've only done 900 miles. Aye, but you've got to get a service because that's a year to keep it under warranty.
The thing is, it sets flags off with the insurance company as well. What's your annual mileage? Oh, about 900 a year. Oh, yeah. I think you're lying.
Aye. There's there's all these different things, but it's actually tying your wealth up and resources that you I mean, basically, you could do better with. And you can actually make more money with the money you've just bought the car with to actually lease the car again. And I go back to that every single time. So this brings me nicely on to the one rent and lease. Don't own, ever. Is there an argument to actually just rent your house?
I suppose there is, because you're no longer tied to having to maintain that property. It's down to the landlord to obviously make sure that things are right, particularly with things like compliance, you know, smoke detectors and gas safety checks and that sort of thing. I mean, I get my boiler thing serviced every year in my own property, but some people might not do that, and they certainly might not get an annual gas safety check, for example. So there is obviously advantages to renting as opposed to buying.
And the same thing is I go back to the car as well. Classic example. You could literally rent a Citroen, a C1. I know everybody doesn't want a C1, to be honest, but right down to brass tacks. I remember when I first started and I looked at the price of company cars, and they were something like £300 a month. And then Citroen was offering the C1 for £100. I was like, what? You're having a laugh. £100 for a wee runabout, a go-kart, which literally you could wrap as a baked bean tin and advertise for you everywhere. And at that time, it was £100 to advertise for 1 week for a wee page in the East Fife Mail.
Yeah.
So a car for a month or an advert in the paper. No brainer, eh?
Absolutely.
But then immediately as well, I come back to saying as well, then if you were going to buy it outright, you would spend £17,000 to £20,000 for a car now. But £17,000 to £20,000 could literally get you a house now on a buy-to-let mortgage, couldn't it?
And I've done it.
Well, that's it. I mean, basically a house on a buy-to-let mortgage. So you could essentially go right in and actually buy that on a buy-to-let and make money on that as well.
Yeah.
Probably a classic example of that is, and I'll show you right now on a buy-to-let. Here's your money in and your 25%. Let me share this screen. Just quickly jump onto that spreadsheet. See that okay?
Yeah.
Yeah, okay. So classic example, here we go. Buy-to-let mortgage, 25%.
Yeah.
Yep. There's the money for your car. There's the deposit. Now, a good car would get you, what, 25,000 for a good car or more? Yep.
Yeah,
so a really good car, you end up buying that for cash. I mean, to be honest, most people lease it, but I'm just using it as an example. You could end up buying a house at 90 grand. 90 grand, that would probably rent for, you'd probably get about 600 for that now, actually. I mean, I'm getting 550 for a 2-bedroom house in Kenway now.
Yeah, so 550 for a 2-bedroom Glenrothes.
Yep. So that's the going rate. So where are we in terms of mortgage interest rates? What price are we looking at now for a buy-to-let mortgage?
289. I've got one at.
So 3% is actually a good rate anyway. I've got.
Absolutely.
Yeah. Mortgage, probably about £1,000 fee, arrangement fee for the mortgage.
The mortgage itself was about £500, to be honest.
Really? Aye, okay.
Yep.
I'm erring on the side of caution by putting 1,000 in then.
That was a mutual find.
So we've got a 90,000, we've got a £600 rent, we've got a 4% your stamp duty you've got to pay anyway because it's a second home, 25% down, so you're 22. So your 12 months occupancy rate, and then down the bottom right-hand corner here, you've got £2,000 for your initial, for your legals and your minor. Legals would cost you about £1,000. Minor improvements, because a 90 grand house, the now in some of the areas or some flats are actually less than that in some areas, are still going to be in good condition, aren't they?
Absolutely.
So literally, you're only needing to do smoke detectors, if anything, and the EICR. and
Small
a
amount
couple
of
of
refresh
compliance
work,
issues.
maybe.
So you
Painting
could
or something.
potentially get that, and I have got that already. So let's look at the numbers in terms of that. So you're taking, when you've taken that out, it's about 428 cash after the mortgage is paid. Now, this is a classic. There's an 8% gross yield on here. So that means if you bought for 90 grand cash, it would be an 8% gross yield. That's buying for cash. But because you use the bank's money, you're leveraging that now to 23% yield, because you're using the bank's money, because you're getting the bank's money for less. You're borrowing at 3%, remember? So therefore, that's more attractive in terms of the return. Plus, you're putting less money in and you're getting more money out. Does that make sense?
Yep.
Yeah, perfect. So, okay, so overheads, I naturally assume 30% for overheads, 15% if you're wanting a managing agent to look after it, and 15% for any repairs that you do out throughout the year. Now, that's just to be cautious out the whole process. That's just me being prudent about it. And that literally gives you a net profit of just under 3,000 a year, which is a 11% or almost an 11% net return with somebody else managing the property. That's a good return, eh?
Yep, certainly is.
What do we get in the bank just now?
I think the highest at the moment is 1.7%.
That's crazy, eh? And a buy to let. But then when you think about it, that's not even taking into account any appreciation in the property. Now, I'm assuming there at 2% capital appreciation over the 10-year period. Seeing this bottom bit, just in here. So I assume a 2%, but that's just 2% every single year of the initial amount. Now, I know that'll compound over the years, so it'll be a lot more than that. Typical example of property prices in the last 10 years in Fife have gone up 46% in Fife. So this property itself would go up if that followed that same pattern. This would go up by 41,000.
Yeah, another thing as well is obviously
about a 5% return every single year on the initial amount you were in. So that's a classic example there. And then when you take the profit into account over 10 years and actually don't spend any of it, this is all about investment return. This is actually compounding your wealth over a long period of time. Your return on investment over 10 years is 250%. That sounds a good return, eh?
better than ploughing into a car, because after the 10 years it's going to be rust.
Car's nothing. So literally, but that is the classic example, isn't it? We've just taken a car and we've instead of buying a car and it wasted to nothing and it's got no value at the end of it, we've taken the same amount of money, got a buy-to-let mortgage, and over a 10-year period, we've actually got a 10-year period return of about 250% on paper. It could be more, it could be less, remember. This isn't exact science, but this shows you how you can take a classic example about what you would normally lay out in a car. You could actually make a 250% return on investment on that same money over a 10-year period just in the buy-to-let process.
And there is obviously opportunities to make even more than that, because if you're buying a house that maybe needs a significant amount of work, then classic example, I bought one for 60, done the full works on it, new bathroom, new kitchen, rewire and so on, and it was revalued at 115. So yeah,
and we'll save that to another show. We'll save that to another show, and we'll talk about that in another show as well, because there's plenty to talk about, because that is a great idea as well. It's the buy, refurbish and refinance as well. Classic example. Next one in the line is stabilise and grow your first floor. What do we mean by that? I talk about shiny penny. Do you know what I'm talking about? It's like, oh, look, there's another opportunity over there. Oh, look, there's cryptocurrency. Oh, look, there's gold. Oh, look, there's silver. It's like, whoa, wait a minute. Stick to your knitting in the beginning, get extremely good at it, and actually get really good at it till a point comes where you don't need to rely on your efforts to do it anymore. Somebody else does it for you, and then go and actually grow your next flow of investment. I mean, is that how you think as well, James?
Absolutely. And I mean, obviously, there's a saying being attributed to Warren Buffett, you know, that you need 7 sources of income. Well, in order to get to that point, you need to be good at the first one and the second and then the third. You know, don't try and swim in too many lanes at the one time, because you'll end up just drowning in the middle.
That is a really good analogy. I mean, probably the classic example now is, and I'll talk about the 47 rule after this. And this is a classic example. a lot of people spend their time trying to make additional income outside of what they do day to day. But what they don't realize is the time they're investing in order to do that and other things. Classic example is selling stuff on eBay, maybe doing a bit of Amazon, you know, I'm a reseller for Amazon, or maybe doing it, I'll tell you what, I'll go out and do some deliveries for Amazon, but they don't realize the cost per hour or the money they're making per hour. It's actually less than what they're getting at their work.
And it's not just that. Obviously, you have to do a lot of research first to make sure you're hitting the ground running and you're doing it right. You don't want to go into something that's relatively new and make a complete hash of it. And before you know it, you're getting chased for tax, and you're getting chased for this, that, and the next thing, and your profit might be minimal anyway.
Yeah,
you know,
and it's remembering as well, especially when you're doing something like that, everything that comes into the bank is not all yours. If you're running it as an investment vehicle, or if you run it as self-employed, because 40% of that's going to go to the tax man. More than likely, it might be a wee bit less because there's advantages of being self-employed sometimes in terms of national insurance contributions. So there's an advantage to that, and we'll talk about that in another show. But it's amazing how many people, and I got caught in it as well. Years and years ago, how I used to focus on the shiny penny all the time, and I used to jump from lane to lane every single time. And it's like, and you know, the one I always remember my mum and dad used to say was, a rolling stone gathers no moss. And I used to wonder what that meant, and I thought, that's hit the nail on the head. It's actually literally because you're jumping from place to place. You're never gaining any traction in what you're doing. Therefore, you're not actually making it or building any wealth for the future. I mean, what you're doing just now and what I do, literally when we get to the end of the year, our counter isn't like a job. It doesn't reset to zero. Actually, we've got our wealth at the end of the year, and then we begin to build on that wealth again. So the counter is no longer at zero any year after that. Whereas a normal day-to-day job, which is, listen, I am not here to knock jobs. Jobs are absolutely fantastic, and they serve a purpose for people that want them, and also for myself as well, because I work in my day-to-day job. I live on my income on a day-to-day job, but all my money goes to investments exactly on the 40-40-20 rule. And that's exactly how I follow this, and I've been doing that for the last 30 years. So I still work a job for that reason, and to maximize the income and maximize my opportunities and maximize my investments. So I'm up for it every single time. So definitely stabilize you and grow your first flow first before you actually tackle anything else. But stick to it and be really good at it. Is that what you would think?
Yeah, that's exactly what I'm thinking. So obviously, I'm using a strategy at the moment, but I'm looking to get out of that strategy. I'm not totally out of the strategy just shortly, but I'm thinking more along the lines of portfolios now, as opposed to single units.
Yeah.
But I believe I've got proficient enough to deal with the single unit stuff that I can now go for bigger challenges.
It is. There does come a point where you can't. Well, for example, for myself, I can't deal with a normal mainstream buy-to-let lender anymore because I'm so big they won't deal with me, and it's the computer says no. So I have to go to corporates now, in order corporate banks. So, and it's fine. That's okay. That's a big plus because corporate banks will give you millions, literally, in terms of what you're doing, based on what you've got and based on what your net worth is. So that's a big difference from what a normal day-to-day buy-to-let lender would do. It's just like, I'll give you 75% of the value of the property. I don't look at anything else. That's all it is.
And it's a challenge as well, obviously, because if you go through the mainstream lenders and stuff, it's relatively straightforward and stuff, but it's that sort of thrill of the hunt and try to secure that next deal and figure out how you're going to finance it.
Do you think a lot of people get after a while they get caught up in the thrill?
I dare say
they lose focus on what they wanted to achieve.
It's easy. I guess it would be easy to do, but yeah,
it's excitement, isn't it?
Exactly.
It's excitement you get caught up in the beginning and sometimes you get to a point where it starts to plateau. Believe me, boring pays well, by the way. When you begin to plateau, the excitement is lost because you understand the blueprint in order how it works, and you know how to duplicate it every single time. And it's when it gets to that point, you actually get bored, and it's like, wait a minute, I never got involved in this. I felt excited in the beginning. How can I get that excitement back? And a lot of people actually do the shiny penny thing, and they actually sometimes self-sabotage.
Yep, you're right. I mean, there's some people that even grow too fast, you could say, as well. That's the other thing.
It's a big thing, yeah. Growing far too fast. I'll do this, I'll do that, and I'll do this. And And while it works for them, in my opinion, sometimes there's a lot of casualties. There's a lot of collateral damage.
It can become a chore.
Yeah.
And you don't want it
There's
to
a lot of
become a chore.
collateral damage round about you, because what happens is they try to do everything at once. Classic example is all the ones that they get 2 or 3 properties and they want to run a training course, and then they want to do something else, and they want to do something else, and want to do something else, but they don't realise in the whole mix of it, there is actually collateral damage. They're giving some people not the right advice in order to get them started, but they've not got enough time to spend on them because they're too busy and spread themselves far too thin.
Exactly.
So it's like what you says. I mean, what did you say about sticking to your lane?
So stick to your lane. If you try to get involved in too many lanes at the one time, you're just going to sort of be sat in the middle, drowning, and nobody wants that. You know.
Yeah, absolutely.
Get good in the lane that you're in. Pick your stroke. Follow it through.
Here's the one I like the best, and this is the one I've used for years and years. And this is the one I use if you love your job. I loved my jobs in manufacturing as an accountant. I loved it, and I could have been there forever. But I realised that I had to move on to build wealth. It's the 47 rule, and literally what the 47 rule is: if you're going to spend 40 hours a week working for someone else, then spend 7 hours at least working for yourself. Because there'll come a day that you actually can't work, and what have you got left if you don't do something for yourself? And I'll guarantee you, a lot of every successful person we know out there actually works 100 hours or more a week. They don't work 40. It's a misconception. Anybody that tells you, oh, I take plenty of time off and I have plenty of time for my family and everybody else, it's like, no, that does not happen. They find the time to work and be efficient, but they also find time to leverage their position. We're going to talk about that later on in other shows as well. How to leverage. How could you create more than 168 hours a week of working? I know how to do that.
Less Netflix. I don't do any TV at all.
I mean, literally, you've got 168 hours a week. Every single week, everybody has 168 hours, but it's how you use them. But it's even how to multiply 168 hours a week, so you have more time working than 168 hours. I mean, it sounds practically impossible, but it is entirely plausible and possible. And we'll talk about that in other shows. So let me just share my screen again, and I'll go back to that screen I was talking about. This is a classic example about this this rule. Is this the one here? Yep, here it is. Okay. So this is the 47 rule. You see that okay?
Yep.
Okay, so there's the 7 hours a week up in this top left-hand corner. Now, literally, if your average salary is 25,000, you're literally on £12, 2 pence an hour on a 40-hour week. So if you spend 7 hours a week working for maybe even if you do an extra overtime working for yourself, you do extra overtime, or you do 7 hours on something else, it would make you that time, then you're in another 84 quid a week. Now, to be honest, 84 quid a week, to some people, it's like, I wouldn't bother. But remember, 52 weeks in the year. So if you do that for 52 weeks, you're in another £4,375.
Absolutely.
I mean, that's a bit more. I mean, only 7 hours a week to get another 4,375. Now, the classic example is, oh, I've got to pay tax on that. Right, big deal. Everybody's got to pay tax on everything. You've got to pay the piper at the end of the day. So you've got a total of tax of £1,750, and then you've got a net amount of £2,625 a year. Now, think about this. This is 7 hours a week. This is only 1 extra hour a day. Give me an idea about where you can get an extra hour a day from.
Like I say, I don't do anything television related now.
I think you said it in a nutshell. Stop watching Netflix.
Aye, absolutely.
So you could stop watching Netflix for an hour. You can go to your bed later for an hour. You can get up for an hour earlier. You could actually cut back on some time or something else that you're doing that's inefficient and actually take that as an hour. So literally, if you do that, stop watching Netflix for an hour, and you're actually 2,000. If you invest yourself wisely, you're another £2,625 a year better off. Hello. Now, let's look at that in an example. If you stuck that into a pension, okay, every year, they would gross it up by the amount. So it's divided by 80% because it's 20% tax.
Mm-hmm.
They would add back on to gross you up to £3,281 into your pension.
Yep.
Make sense?
Yep. And
so just by working an extra 7 hours that you didn't have before, you're earning £3,281. Okay. Now, can I just say, over 40 years, that's another £131,250 over 40 years. Wow. Who would like another 130,000 just for using the time they have already? And that's a classic example. So I'm gonna share another screen, and I'm going to refer back to that one if everybody's got that in their mind. Here we go. Here's this one, the compounding calculator, coming back to this. And this is why I gave you a look at this before. See that okay?
Yeah.
So let's take the zero rate, okay, before. So we've got the zero rate, we've got the 40 years, and we've got how much we were earning in a year? Was it 3,000? Yeah, 3,281. So 3,281 a year. So 3,281 yearly. And just calculate that. Now, when you think about it, that's another 131,000 you're saving, or you're just making. I mean, it's the time you had already, so you're not actually going out and doing anything else, but actually generating that. So another 131,000 a year. But the tax man has grossed that up. So what you're getting out of that is 2,625. Just give you I'll just tell you the now. 2,625. That is actually 2,625. You're actually only putting in. You're only putting in 105, because remember yours was 2,625, okay? And then they put the tax on to get that up to that. All right, makes sense?
That's right. It's a pension tax relief. Yep.
Yeah. So 3,281, and it'll be even higher if you're actually a higher rate payer. So we'll bring that back to where it was. So you've only got 105,000 in there. Was it 2,381 if I hit that wrong button there? 3,281. I want to get this right so everybody understands. 3,281. Yep, 3,281. So you still put 105 in, and basically the tax man's going to add on for you round about £26,000 and extra tax just back to you into your hand. Okay. So here we come here with 105,000 that you've earned just out of taking that extra hour out of no watching Netflix, getting up at night, going to your bed an hour later and doing an hour, or getting up in the morning, maybe working an hour earlier, or spending another hour each night at your work because they wanted you to work a wee bit overtime. You could do an extra shift or something like that, or add on to that value and keep doing that for the next 40 years. So in the next 40 years, if that grew, would you think 5% is an adequate return for pensions?
For a pension, somewhere between 5 and 7, I think, at the moment it is.
We'll say 5. We'll use 5. So that in that scenario, 105,000 at a 5% return over 40 years would come out as £396,000. So 105,000 has now been 396. That's almost 4 times the amount. So you've earned 4 times the amount. Could you imagine if you were earning 10% a year and you took that and it was 105,000 and it'd be worth £1.4 million? Wait a minute. We were only on about 400,000 before, were we no?
But we're now buying assets with ROI.
Yeah. So we've now compounded another £1 million or another 900,000 in interest just because of that. But then when you think about it, that's a 10% annual return. So that's compounded you up to 1.4 million at the end of it. And I will just stop sharing that screen and I'll come back to this classic example as I had here.
One thing you might want to mention, Jim, that obviously that takes you above the lifetime allowance. It's worth bearing that in mind. Yeah,
there will be restrictions and stuff like that. But for the simplicity of the exercise, let's look at this and let's just jump back. So that was a 10% return, brought you 1.4 million. And look what we get there. Property investment. 10, 11% return net. So basically 105,000 in property invested wisely over the next 40 years could potentially earn you how much? 1.4 million. Classic example about the 47 rule. If you're not going to do it for yourself, why are you doing it for a boss? So you need to do something for yourself. So I always talk about the 47 rule, 4-7 rule, and we'll talk about that in successive shows from there. We could break this down to a show for every single one, couldn't we?
Absolutely.
Classic. Always stay broke. Why do I say that? Stay hungry every single time. Get up every single morning like you're broke. Because I'll tell you what, if you think every single morning that you're broke, you'll go out, you'll stay hungry, and you'll have more energy every single time to go out and make it happen. It's amazing how many people, I'm 55, and it's amazing how many people in their 30s have just not got the energy level I've got. And it's basically because I stay hungry every single time. I could run out and buy a Ferrari. I could run out and buy an Aston Martin. It makes no difference. But the key is I do the 40-40-20 rule. I stay broke. And I deliberately do that in order to keep myself hungry, to keep myself energized, to keep myself motivated. Money is no good for money's sake. You need to invest it and you need to make it work for you. Would you say that's the case?
Well, that's the bottom line. Do you want to work for money or do you want money to work for you?
Yeah.
I guess.
So is it better to keep your money sitting in the bank or is it better to do something else with it?
Money in the bank's dead money, as far as I'm concerned. But with inflation the way it is now, 5.1% or something, your pound today is worth less than the pound yesterday.
Yeah, and it'll be literally worth 95 pence in a year's time, literally, because it's at 5%. So classic example of that is if you leave your money in the bank, it'll be worth a lot less. Therefore, you need to make it work for you. Therefore, you need to use systems in order to leverage it more. IKEA just announced the other day that they're putting the prices up by 10%.
Yes.
Guess where inflation's going? Up.
And there's a lot of pressures.
Energy prices are going up.
Yep.
Do you want to continue for the rest of your life to struggle by every single day? When if you do a couple of, I've showed you there exactly, I've showed everybody there exactly, another 7 hours a week spent on yourself that you would otherwise use for doing something else, which is a complete write-off of time, and invest in that over the next 40 years. Even if it's no 40 years, don't see the bigger picture. Just look at it as a week-to-week thing, and then a year-to-year thing, and then a 10-year to 10-year thing, and then after that, it's a 40-year thing, and you think in 40 years' time, you think, wow. Even in 20 years' time, you think, wow, I could never have it. Now, do you know how I know this is the case? Because I took out pensions for my kids at that very amount when they were, and they're sitting now on each round about 100,000 in terms of their pensions, and they're in their early 20s.
And there's a lot of people my age not even anywhere near that.
Aye, and that's mental. And that's another thing. I actually went onto the pension website, and we'll go on about this, but I really got my bugbear the night. I went onto the pension website the night from the government, and they actually assumed that you start your pension at 18-year-old, when that's an absolute lie. You can start a pension for a child from birth, and it's perfectly legal, and the government give you the money back and tax up to the low rate threshold. So if you put £2,880 in total every single year, the government will top that up for your child to £3,600. And look at that example about what I used before about your child's pension at £3,600. We'll not digress onto that because we're running short of time, but we'll talk about pensions later on as well as one of the wealth building strategies, as another string or another revenue stream, but it must be a long-term stream. It can never be I can get the money back whenever I want. So that's why. So key here is always stay broke, stay hungry. It's where you get most of your energy. Have that vision, have that dream, but stick to that disciplined plan. This has got to be the best one. And the obvious one, never lose money. Now, I'll be honest, there's been a few times I've lost money. But the great thing is my gains have been far greater than my losses. So you're never going to get into anything. And I don't know if you've come across this yet, James, when you've had a loss.
I've not actually had a loss yet. I've been quite fortunate in that sort of respect. But
well, hopefully, take my hat to you. Hopefully, you'll be lucky, and you will. Well, luck, labour under correct knowledge. We know that. So hopefully, you'll be in a position where you'll learn from other people beforehand, so you'll know not to do that. But there'll be a few times that you can't predict things. There's circumstances outside the realm of what you're doing. Maybe the government intervention or anything like that affects you and your income. Therefore, you can't do anything about it at all.
Well, it just takes a tax change.
Yeah,
Something
it
simple as
literally
that.
does. Tax change is a classic example. Another classic example is I ran and bought a new build in the beginning at Vetri and Ovale, and I lost 25,000 on it 2 years later when I sold it. Luckily, my capital gains were far more than that. So I was able to use it as a capital loss against a capital gain, therefore minimize my tax position as well. So I was able to do that at that time. But that was the very last time I'll ever buy a new build for buy-to-let or investment purposes, because new build has so much profit built into it already. You're literally at the end of the realm. And at that time as well, everybody was buying new builds before the credit crunch. They all got hit with it as well up in Glenrothes and stuff like that. And literally, that's hardly even recovered back to its existing amount. It literally took about 10 or 15 years for them to get back to where they were. So never lose money. That's one of the things I lost money on. Another thing was due diligence. I didn't actually check. I walked into a property. I really thought I had the Midas touch at the time, and everything I touch turns to gold, as you do. When you get to that stage, you kind of think, wait a minute, I could do everything right. And literally what I did was I walked into a property, and it was so low in value that I thought I'm just going to buy it. But then one of my builders went round one day, and I had it rented for a while, and then one of my builders went round when somebody moved out, and I thought, I'm going to get a refurb. I'm going to get maybe the bathroom changed. Took out the bathroom. The whole floor was rotten. And it wasn't just that floor. It was the floor right through in the bedroom, because the floor went underneath it, and then it was the floor right through in the living room as well. So it had gone right round dry rot all the way round. So literally it destroyed the whole flooring. And then what happened is we realised that we wanted to do double glazing. The timber mullions in the top, they were all rotten. So I had to then put lintels in, actual concrete lintels in. And then I wanted to do the kitchen, and I realised I had to rejig the electrics to do that. So it cost an absolute fortune. Luckily enough, I was able to sell at the peak of the credit crunch. Therefore, I got more than my money back plus profit. So it was one of the properties I definitely learned a lesson on, but I was lucky enough to actually be able to take advantage of some of the opportunities at the time. There was a grant system in place at the time. It was a 50-50 scheme to get empty homes back in. These still exist today, some of these empty homes initiatives. But I managed to utilise that as well, which actually was able to offset it. So I was lucky in that respect. That was the two things I lost out on big time. And I've learned very valuable lessons that I've been able to pass on to other people about due diligence and that. Next one, I think, is probably, what's the difference between cash flow and cash?
So cash flow is the money in your pocket, but what you want your cash flow is what position you're in after you've paid everything off from the rent you receive.
Yeah,
well,
cash flow's king, isn't it?
Yeah,
and literally, and I don't carry it, but cash is trash. It's like cash is nothing. It's a bit of paper with a promissory note, and every time you hold on to that paper, it devalues every single time. But you know yourself, cash flow is generated from assets, from income and wealth creating assets and income producing assets. That's why the cash flow is the most important thing, and cash is nothing. So literally, if you've got cash sitting in your house, it's devaluing every day you go. Anything to add on that before we move to the final one, James?
Well, I think you've hit the nail on the head with that one, Jim.
It literally is. I mean, it's the cash flow is investing. It's the blood of investing, and creates wealth over a period of time. We've just demonstrated that, isn't it? I mean, it's just generating, putting that cash in, investing it, and reinvesting it all the time, and it does that. Final one for me is literally the ultimate. Never quit until you achieve your financial goals. This is when I talk about taking massive action, having massive goals. We can talk about this, can't we? Because last year I started off at 8 properties. I thought I'll buy 8 properties. That's all I need this year. And then I had an epiphany, and I thought, wait a minute, what am I doing? If I'm going to buy 8 properties, I'll probably end up buying 4. And I thought I need to say something. I need to talk about it. This is where it's important about goal setting. You need to talk about unrealistic goals that are going to frighten you, goals that are going to push you, and goals that are going to make you think completely different. And literally, I said to myself, I'm going to buy 50 properties. I had no idea how I'm going to do that, and no idea how I was going to achieve that. But I tell you what, all of a sudden, my brain started to work into it, and I talked about it as if I owned 50 properties, another 50 properties already. And as a result, I ended up buying 17.
Yep.
But I do not believe that I would have bought that amount of properties if I hadn't have set that goal of 50 and I'd stuck at the goal of 8. I would have got to 8 and then forgotten about it, or maybe we even got there.
And I'm in exactly the same position at the moment. I've got an opportunity for 12 flats, but my target was in and around that this year anyway. So if I get them now or within the next month or two, then I'm already ahead of target, but I'll still keep pushing.
That's key, isn't it? Now, you've hit the nail on the head, right? You set your goal of 12, right? Now, you might have set that goal last year, but even though you fall into this year and you miss it by 2 or 3 months, who cares? That's the reality. Who cares? It's better than what you would have had before, which was nothing.
Correct.
But what's the most important point of having these 12 properties is how much is the portfolio worth?
Well, we're still in discussion what it's actually worth.
Million?
Just round about 1.1.
Right.
Million.
Let's just say it's worth $1 million. So your property portfolio is worth $1 million. Let's say you had no money in it at all. So therefore, you managed to acquire the properties, but you actually didn't own any of it. Therefore, your net wealth in these properties is zero. Okay, so you've got zero wealth in that property. Oh, I'm a property millionaire, but you actually don't have wealth millionaire. But I tell you what, in the next 10 to 15, 20 years, you will do, won't you? Because these exact same properties that you don't have any wealth in will actually double or triple in value, and you will have that wealth, won't you?
Absolutely, because
and that's what people forget. They don't understand that dynamic of wealth creation and property. It is literally a system that pays you. And the great thing is you're getting paid rent every single month as well at the same time.
I think the whole portfolio is something like 7.2 thousand a month in rents.
Wow. Yeah, that's brilliant. And that's exactly what it is.
They're all tenanted, so no immediate refurb required. They're all let as it is, so all like smoke detectors, all that good stuff.
So rather than going to reinvent the wheel, we're buying income-producing assets straight away.
Yep, income producer from day one.
Yeah. So from day one, rather than actually saying, I tell you what, I'll buy a property, I'll have to refurb it, I'll have to do this, I'll have to have no rent for the next 3 months, so I'll have to do this, and I'll have to do that, and I'll have to do this. Wait a minute, I'll just buy it and I'll earn money straight away.
Yes.
That's what I talked about boring. Boring pays well, doesn't it?
Absolutely.
But it does. And literally for people out there, now my target market for me personally is people like me. We're professionals, and for yourself as well, we're all about professionals and helping professionals in order to achieve something outside of what they do in their day-to-day business and their day-to-day jobs in order to create wealth as a result of that. And that's ultimately what we're out to do. And we're not at entry level. We're not there to teach everybody to try and do this from scratch. It is literally, we're looking for people out there that are looking to build wealth, looking to joint venture with us over a long period of time, a medium to long term, in order to create wealth for both of us. Because I'll guarantee you, people that joint venture with us will naturally just win as a byproduct, because we'll always win it anyway. And we'll make sure of that. So just by hanging about us, they'll be wealthy.
Well, that's it. We've got skin in the game, so yeah.
You've hit the nail on the head. If you've got skin in the game, then the exact thing, you're going to make damn sure it works. That's the reality for coming out of it. And so if anybody's out there, you're wanting more information on us, please feel free to message us direct, touch base with us, and then we'll give you more insight into this. And until next time, guys, it's Jim Parker from Fife Properties TV, and bye-bye from James as well.
Thank you.